Buenos días, muchas gracias por conectarse. Bueno, como ustedes saben, Vision es una compañía que está orientada a las inversiones internacionales ya por más de 20 años. Y en este contexto, nosotros tenemos una relación con Lansdowne Partners hace cerca de 5 o 6 años ya. Y una compañía que nos parece muy interesante es una compañía inglesa, fundada en 1998, que tiene aproximadamente 10 billones bajo administración, 10 billones de dólares bajo administración. Básicamente gestiona estrategias activas en mercados en equity, en mercados desarrollados, particularmente en Europa, también en China, algunas estrategias sectoriales globales, con una filosofía de inversión básicamente basada en análisis fundamental y muy intensiva en seguimiento y reuniones con la compañía. La casa matriz está en Londres y el equipo es de 90 personas. Nos parece muy interesante poder hoy día escuchar a Yang Wu, portfolio manager del fondo de China, con una visión que a todos nos interesa conocer más de China, de cómo se ven las inversiones, la economía en los próximos años. Nosotros lo hemos escuchado antes y nos pareció que es algo que de todas formas le va a aportar al resto de la gente. Eh, los voy a dejar ahora con Jennifer Wood, quien es la persona con la que mantenemos el contacto permanente. Ella va a hacer una pequeña introducción de la compañía, mejor que la que puedo hacer yo, y después con Jan unos 30-45 minutos, 30-35 minutos, perdón, y después va a haber un espacio para las preguntas que la idea es que las envíen por el chat. Así que gracias por conectarse y los dejo con Jennifer. Jennifer, go ahead.
Wonderful, thank you. Good morning, everybody, and thank you for joining us today for this discussion on the investment opportunities we're excited about in China. First off, I'd like to thank Camilla, Arturo, and Juan for all their help setting up the video conference and the support that we get from Vision. Thank you very much, guys. My Spanish isn't too hot, but I think I'm going to reiterate a lot of the things that Arturo's just kindly said about us. But before I do, two quick housekeeping items. First off, Yang's going to be presenting some slides to you this morning. They will be sent around after the presentation, so you'll receive a copy of the deck. And then second, we will have time for questions at the end. We'd really love you to submit them using the Zoom functionality within the app. So my name is Jenny, as Arturo said, Jennifer Hood. I've worked in the business development team here at Lansdowne for 7 years, and I cover the South American region from a client perspective. Lansdowne was founded in 1998 and manages just over $11 billion for a global client base of predominantly institutional investors. I think what really sets us apart is we are exclusively focused on fundamental and active equity strategies across different regions and sectors, both long short and also long only. Our objective here at Lansdowne is to generate compelling long-term financial returns for our clients by employing exceptional investment talent like Yang within a leading edge compliance and operational infrastructure. So I'm joined today by Yang Wu, portfolio manager and head of the Greater China strategy, which we'll be talking about today. Yang's been with us at Lansdowne for just over a decade. Initially, he worked in the research team of the European team, which launched in 1998, launched the firm in 1998. There he was focused on fundamental analysis and building the risk management tools for the European companies and Chinese companies as well that team looked at. He was instrumental in building the portfolio risk management system for the strategy as well. Prior to joining Lansdowne in 2008, Yang obtained his PhD from Columbia University in physics, where he received the Towns Fellowship and his degree in physics from Fudan University in China. So with that introduction, I'll hand over to Yang to lead the discussion on investment opportunities in China. Over to you, Yang.
Thank you so much, Arturo and Jenny, for the very kind introduction. And hello, everyone. I really appreciate your interest and opportunity today to discuss our thoughts and frameworks in China. And despite all these geopolitical conflicts or noises on a daily basis, I mean, to us, it never felt more compelling today about investing in China than any other time in our fund's history. As Jenny probably said, my short resume is essentially a small footnote of China's history of opening up to the world. I grew up in Shanghai, China, and then went to Columbia University in the US to study physics through CUSPIA program, which is the first program connecting US and Chinese university. And after obtaining the degree, I joined Lansdowne European Fund, and also that's thanks to the increasing link between European business and China market. Now I'm managing the newly launched China strategy in Lansdowne. This is enabled by the gradual opening of the capital markets in China. At the fund level, after I joined Lansdowne in 2008, I started first in the European fund by investing in both Europe and China for the first 9 years. And at the peak of the fund exposure, we have about 300 million exposure to China. In 2017, we launched the standalone China strategy. I mentioned this history specifically is because the experience of investing both in Europe and China at the same time give us a unique perspective and advantage for investment in China. And now personally, I spend half my time on the ground in China and half back in our UK base. So now I'll share the screen and we'll start the discussion. So hopefully you could see it clearly. So with for those who knew Lansdowne Partners, we have been a long-term fundamental investor in European and US equity since 1998. How does this new China strategy fit within the firm? And also why our investment framework and experience fits the current phase in China? There are broadly speaking 3 types of market. As you can see on the chart, we call it emerging, developing, and developed. During the emerging market phase, the market is more volatile and more driven by macro or top-down bets. When I joined the firm in 2008, China is more in this category. The second phase of investing is what we called developing market, where the macro is more stable. And investing is much more about value creation and stock picking. European companies are going through this phase in the past 20 years. The final stage, of course, is developed market, where minority shareholder value is fully respected. Over the last decade, while we were investing in China, we sensed that China is now crossing this first phase and entering the second phase. Therefore, it makes our expertise in the developing market period particularly applicable. For instance, a very important source of the alpha generation is from improving corporate efficiency. This is also what we did successfully in Europe for many, many years. Now China is following Europe's step to go through this developing market phase. We're basically carrying out the similar strategy. I remember when we approach when I joined the firm, we were approached the European managements. We're using a US corporate restructuring case as a role model to convince the European managers to do the right thing for shareholder. Now basically we repeat the same process in China, using European corporate cases to help Chinese management. One thing I want to emphasize, the degree of mismanagement in China sometimes is a lot higher. It simply implies there is more room for value creation. If there is one chart I would like the audience to take home today, it is this one, even if it looks most unprofessional. And I'm really grateful that our compliance colleague actually signed off it. It highlights the very sizable opportunity in Chinese equity markets in a kind of cute way. Obviously, the eagle here represents the United States, the panda here represents China. The first line shows the relative size of GDP. Today, the United States generates about 25% of global GDP, while China is second behind at around 17%. Okay, so far so good, nothing wrong here. However, if we examine the equity market representation, which is on the row below it, here it is measured by the weighting within MSCI All Country World Index. US is taking around 55% share, while China is only about 5%. So in another word, the Chinese equity market, it is still very small or early on a global stage. Also, it's also much smaller relative to its GDP size. But wait, that's not the whole story. If one take a closer look at the panda on the lower left-hand side, it has a gigantic head, but the body actually is even smaller and more underdeveloped. This is actually done on purpose. It indicates the relative development stage of the different parts of the Chinese market are extremely uneven. And this is a highly unique and exciting feature of the China market, which we will constantly revisit in our webinar today. And also surprisingly, a distorted panda looks cuter than their normal size one. But one might ask a question, a more serious question: how even can this imbalance be? How even this imbalance could be? Let me give you some numbers. On a per incremental capita base, China's housing starts, so building houses basically, is 30 times of that of the United States, 30 times. While on a per patient base, China's diabetes drug spending is only 1/30th, so 1 divided by 30. So now we have two sides. On one side, the housing side, which we're like 30 times more, on the other is 1/30th. So diabetes medicine consumption, in pure math term at least, it's 1,000 times smaller versus housing. And if housing represents a head, while diabetes medicine spending represents the body, the head should be 1,000 times bigger. We didn't even draw the body small enough, apparently. Now let's look into the future. For instance, it is projected by IMF that China will represent about 25% of the world GDP by 2030. So essentially double in absolute size from today. An equity market actually have a better shot because it could achieve a bigger portion at the global stage by then, or it could achieve a bigger portion relative to GDP. So a decent upside overall. But the most exciting story I want to highlight here, and also hopefully you could take home with the message, is that the underappreciated panda body, as you could see from the chart, could generate a much higher upside after the normalization. When we study it, the upside could be 10 times or more. And the current reality is most investors in China are investing in the panda heads, because obviously these are the obvious ones. In contrast, I think our investment know-how in great European companies such as AB, InBev, Nestle, Allianz allow us to actually find underappreciated franchises in China at a much earlier stage. So the panda heads is not where we focus on, but the panda hands, panda fruits, panda bodies where we actually are looking in detail today. So enough cute animals. Now please tolerate some boring charts here, try to explain why this economic structure or the panda is out of proportion to start with. Why it will normalize as China grow from here. And most importantly, why this will happen quickly. Among all the drivers, there are two important shifts coinciding in China, which makes the effects kind of amplified, or more amplified than any other parts in the world. The first shift is demography. On the left-hand side, which we plot the working population of the world, which mostly of the developed world and China put together as a function of time. As we show here, since 1980s, within merely 30 years, China essentially doubled global labor force, by opening up to globalization and joining WTO. This shock creates huge deflationary pressure on labor cost and consumption, especially in China, while boosting importance of capital and investment. However, this demographic trend will soon reverse as the effect of the one-child policy start to manifest itself. In fact, we already saw the underlying impacts on manufacturing wages, which on the upper right-hand side, as you can see, quadrupled since 2007. And even if the government abolished the one-child policy since 2016, the newborn trend is still stubbornly trending down. As a result, the shift of demographic trend will drive the economy towards more labor inflation and consumption, rather than previously investment or exports. I remember anecdotally, we visited Hong Kong in 2008, and we had a casual conversation with the management. And the management, Hong Kong management, was complaining that the Hong Kong nannies or domestic help's wage is 5 times higher than mainland in 2008, and it was not easy to hire a mainland, nanny to work in Hong Kong. And today, guess what? Actually, mainland nanny in big cities like Shanghai is 2 times more expensive than Hong Kong. So the in and out is about 10-fold change in 10 years, a very dramatic change. And superimposing on this is what we call the generational shift. So it is not only the shape of the population structure is undergoing rapid shift, but also the composition is changing rapidly. On the upper left-hand side, you could see since 2001, college admission in China took off from about 1 million a year to 7 million a year. And among the 7 million, there's about 4 million, which is science and engineering. And these educated new generation is rapidly changing the behavior at both the company end and the market end. I mean, thanks to them and also the quickly rising labor cost, the company are quickly shifting from low-end manufacturing towards more innovative R&D. For instance, on the upper right-hand side chart, one could see that the change of patent applications. Since 2010, China has increased dramatically its patent filings, and also now it's more than the next 4 countries combined. And also, unsurprisingly, these must be the most open-minded adopter of modern technology. While their parents are still using cash, they have long started using phones, and even as a picture below show, they're using their face to carry out a payment. You don't need to bring your phone even to finish the payment. And due to this rapid generational shift, China essentially in payment industry perspective essentially bypassed the entire credit card phase. In addition, consumption market is also undergoing structural changes as well due to the very different consumption preferences. On the lower left-hand side, for instance, my parents' generation, they consume primarily Chinese spirits, what we call baijiu. They consume baijiu in large family gathering or business banquet. However, the new generation, prefer to go to bar or karaoke or club. They drink wine, whiskey, beer, tequila, or cocktail. And these profound shifts is everywhere, and they create very sizable opportunities once we understand them. Now, hopefully I've convinced you there is a significant stock market opportunity driven by ongoing socio-economic shifts in China. Now the question becomes how we identify them. Here we list 3 categories of structural opportunities, what we focus on primarily. The first category is what we call core growth. Why instead of simply just core growth, we call it a fancy name called core growth. It's actually because the growth opportunity, as we explained earlier, in China is very unevenly distributed. Therefore, it's only concentrated in a few selected areas. And this is quite a unique feature, as we said, and other emerging markets tends to have a more broad-based growth. The underlying reason, to summarize again, is extreme level of accumulated imbalances in China's current socioeconomic phase. We have given you the diabetes versus housing example, as discussed earlier, as an example of how large these imbalances could be. Now, one might argue, to play devil's advocates, the diabetes and housing are entirely different industry, right? They could be just very different for a long time. But now let me give you a more close related example. Now let's compare beer and spirits, since we mentioned over the last slides. These are both alcoholic beverage, right? So China's #1 spirits brand, for those who know China well, it's got Moutai, is more valuable than the top 200 global spirits brand combined, whether it's whiskey or brandy. So one is larger than 200. While China's number one beer brand is worth less than 1/5 of the global leading brands. So China's number one beer brand is Snow, the global leading brands is Budweiser. So something is not right, right? In one case, one is larger than 200. In the other case, one is smaller than 0.2. A whopping gap of 1,000 times again. It's like a magic number. So we're not, of course, saying we find a 1,000 time upside here somewhere, but you get the idea. Something is out of place. And if we understand why, how, when this will change or rebalance, it will be very exciting multi-bagger opportunities. One might be curious whether this imbalance exists in other emerging markets. Not as much. We've done analysis in other areas. The ratio tends to be like 1 or 2 or 3, 4, rather than 1,000 in this case. As a result, upside from these core growth area tends to be very attractive, as indicated on the slides, which typically between 5 to 20 times over a time horizon of 5 to 10 years. The second category is what we call deep value. Because of the heavy retail participation, which is about 80% of total trading on the market, mispricing is much more pronounced than any other markets globally. As a result, even though the overall market valuation is neither on the cheap or an expensive side, it's kind of fair, but the extreme mispricing opportunities are within the market. The typical upside we look for here is between 2 to 3 times over a shorter period, which is about 3 to 5 year time horizon. The last category refers to more company-specific action to unlock value, which we call reform or restructuring. There are many SOE or private family-run business in China who doesn't prioritize minority shareholder value. Companies in China tends to be, especially SOEs, tends to be obsessed with growth and expansion. Private company also is very ego-driven, so also want to gain larger market share, etc. In the early stage of China's growth development, this actually works because there's a lot of growth opportunities and there's a lot of credit. However, now the growth potential is reduced and the leverage of the entire system is already at very high level. So running a company more efficiently and allocating capital wisely become increasingly important. This is exactly the character of the developing market. Some of the company do have great underlying franchises. So when they do the right thing to improve either capital or operational efficiency, significant value could be unlocked. And the typical upside in this category is around 50 to 100% within a more shorter time horizon, 1 to 3 years. So basically the 3 categories might look a little bit messy, but they are really 3 angles targeting the same issue: imbalances or inefficiencies. The only difference is the core growth category is sort of try to analyze the whole thing from an economic perspective, while deep value is analyze it from a market perspective. While in the end, reform and restructuring is more targeting the issue from the company perspective. Now, let's discuss some of the detailed example of each category to illustrate more clearly what we target or meant. On the core growth, here we plotted the market value of a particular sector in China versus the world. The dark blue here indicates China, while the light blue here indicates the rest of the world. Obviously, the left-hand side, such as spirits and life insurance, where these areas, it's obvious China's development is quite advanced. Sometimes you could say it's a little bit bubbly. However, on the right-hand side, we plot brewer and non-life insurance. The picture is very different. Even if spirits and the brewer are, we discussed earlier already, are very similar categories, so is life insurance and non-life insurance, right? After all, they're all insurance company. Why the gap is so large here? It is not because Chinese don't drink beer or drive car. I mean, they certainly don't do them together. But in fact, actually, China is the largest auto industry and the beer market by volume at least. So, what's wrong here? We have discussed earlier that, due to demography and a generational shift, the growth driver will shift from investment to consumption upgrades, right? And people understand this picture and the implication for such as cement or steel consumption, because in these areas it's obvious. These are investment driven and China consumes more than the rest of the world combined. But why is this relevant for alcohol consumption or insurance products? This looks more like consumer products or consumer services. In fact, investment is so dominant in China that many seemingly consumer category are actually investment in nature. For instance, a significant portion of high-end liquor is either hoarded for price appreciation, more like a collector market, or spent as an investment in the format of gifts or bribery to a certain extent, or consumed at a business banquet. These are investment in nature because you expect a return out of it. It's not for your own casual consumption. Life insurance similarly reflects a high savings ratio and investment needs. In contrast, beer and non-life, which is primarily auto at the current stage, auto insurance, are mostly driven by mass market with nothing to do with investment. I mean, you don't invest in car, and you certainly don't invest in a beer. A car is a depreciating asset, and a beer has only 6-month shelf time. So in summary, these are another two concrete examples of how impactful these socioeconomic shifts are on business, and potentially into the future, how significant the upside will be as a result. If the Chinese spirits functioning as investment is more a culture subtlety, the example on this slide is just so obvious. It's mispricing. That's it. This is what we call deep value. The left-hand side, what we show here is so-called dual exchange valuation gap. Basically, it means the same share price. The same share of the same company, but listed on two different exchange, and the price difference. In China, it reaches as much as 180% on a median. It's kind of dualistic stuff. Median, not the maximum, median, while it is sort of negligible in other regions. On the right-hand side, it shows the valuation of leading stable companies in their own verticals. These all have very stable profile and a very similar growth rate in their earnings the next couple of years. While when we compare their valuation on such as EV/EBITDA multiple, which is a valuation metric, it varies dramatically from 5 times to 50 times. This is a 10-fold gap on valuation alone on leaders, not on a small plateau on the markets, but leaders in each segment. Hopefully this remind you again about this, very cute panda, a giant head and tiny feet. On page 10, there is a lot of information on this page. This is a reform and restructuring case we did on the largest brewery brand in China, China Resources. Without boring you with all the history of investment in it, I want to highlight 3 important messages from this example. First, we're quite long-term, where you stay invested across the 3 different phases, from restructuring all the way to consolidation and privatization. And there's a very long period of time, and it returned very good for us. Secondly, the room to create shareholder value in China is simply greater than other regions we've invested in the past. For instance, at the end of the restructuring phase, which is about 2015, when the company finally decided to dispose its non-core assets, which is primarily retail business, the share is up 60% on the day, right? And then gained a further 400% since then. So 60% in a day simply because they did something right. The last message is, we couldn't possibly do this if we don't have a synergy of our global perspective with local insights. For instance, during the second consolidation phase, which is in the middle, as an investor in us as an investor in European breweries such as ABI, we're fully aware of the implication of the deal to acquire Sepp Miller, because Sepp Miller has about 49% of the stake in their China joint venture. And if ABI acquires Sepp Miller is obliged to sell back 49% to China Resources for non-compete clauses. Essentially, you could double the company's presence overnight at little cost. So as you can see, the share price doesn't reflect, on the day one, but it gradually realized and gained substantially over the period of 2017. So in summary, this hybrid perspective is sort of the key enabler to help us and also the company to unlock substantial value over the long run. Since 2018 and the trade war and then now the COVID, the world is constantly shaken by bad news or geopolitical tensions. It does impact the overall growth and bring volatility back to the markets, such as 2020. However, counterintuitively, from a more investment perspective, it actually offers us a enlarged scope or playground to search for more exciting stories in China. Why is that? Because previously, we mainly constrain ourselves, even though the whole panda story is nice, but we still have to constrain ourselves on businesses with localized barriers, such as branches or distribution. Why? Because if, take Starbucks, for instance, even if China's coffee demand quadruple from here, it might just add another 20% bump on the stock. So it's diluted by the global presence. So you have to be local to be enjoying the growth opportunity exclusively. And also, local business could offer certainty when you have a defined market, a defined entry barrier. That's why previously we only invested in business such as beer and insurance, where the products are heavy to ship or local branch network, very hard to replicate. Now, as the world is deglobalizing a bit, many new barriers start to emerge, especially in China market, including national security, technology self-sufficiency, and culture factors. And these barriers not emerging overnight, but it's gradually emerging. And as it emerging, it's gradually turning many new markets into kind of playgrounds we could search for exciting opportunities. For instance, given the national security concerns, software industry in the future and aerospace, in the future would be more national business rather than a global business. And also, when we think about tech self-sufficiency, semiconductor and the medical technology would become more a localized business. And because of cultural differences and cultural, nostalgia or cultural pride, brands with national symbol was going to become more popular into the future versus international brands. So all these stories, even though it's not overnight or not black or white, but it's gradually shifting. And we are very excited because this offers us as a researcher, an investor, more room and more certainty to look for. And also, even if this trend only started recently, these new areas is already a very significant part of our research and also contribution to the fund. In the next couple of minutes, I'll give two stock examples if time permits. The first is a traditional local business, which we've invested for a while. The second is sort of the new areas we find investable more recently. To start with, we have China Food. This is the largest and the smallest Coca-Cola bottler listed globally. It's two contradictory words in the same sentence. It again tells you how out of balance things could get in China. The bottling business tends to be a monopoly local business over a certain territory. So therefore, it's extremely good visibility and certainty. China Food controls a territory of around 700 million population, so half of China, essentially making it the largest bottler, independent bottler globally. While its market value of just around $1 billion make it smallest in value terms, which if you look at on the right-hand side, on the upper right-hand side, we have plotted the enterprise value and the population under its franchise. So even if we don't do fancy understanding or fancy studies, from the chart we could see a whopping valuation gap about 20 to 30 times on a per capita basis if the company reached the level of its global peers. Not necessarily developed market, just average global peers. How could a great business be buried so deep? Again, I mean, in the broad picture we already explained, there's socioeconomic imbalances, but in more detail, here there are many factors. The first is a very complicated corporate structure to start with. When we visit them back in 2010, they're very messy with 4 underlying businesses fighting for resources and generating not very stable profits. Over many years of discussion, the management finally embarked on a series of action to clean up. So now the messy corporate structure is already cleaned up. Another important factor is the product mix and pricing is still low and at infant stage in China. So on the lower left-hand side, you can see China's Coca-Cola products retail pricing is a fraction of other regions. So my advice is always to other friends coming to China is don't buy Louis Vuitton in China because it was twice the price of Europe. But do buy a lot of Coke, to drink a lot of Coke, because Coke is way cheaper than Europe. But jokes aside, and this is an amazing anomaly because most of the cost are global commodities. And this also explains why margins are depressed. Therefore, we believe there's ample rooms for price increase and mix upgrade. For instance, zero sugar or Diet Coke basically have only about 2% penetration in their franchised area, but close to 40% in UK. Now, what is more amazing is because of the premiumization, Diet Coke products such as Coke Fiber is priced at 50% higher per unit than the regular ones, despite actually the cost will be lower. So there is ample room for margin improvement as well. Not to mention, Coke's price has been, hasn't been raised for many years. And if you just raise the price a little bit, the margin would go through the roof. And then this is not just a boring company. There's a lot of new growth coming. New categories are coming out very fast. For instance, Monster Beverage, Costa Coffee, all these premium products also rapidly growing, doubling year on year. Over the pandemic, the sparkling volume, which is essentially Coke, Sprite, actually grew while versus the decline of other category. Shows its products is really, really resilient. Therefore, when we put the numbers together on the lower left and right-hand side, we estimate the long-term upside for the stock. If we consider the mixture of pricing, margin improvements, volume growth, and potential corporate refranchising, could be as much as 16 times. I mean, Coke is just another anecdotal example of how price-sensitive Chinese consumer historically has been. And I'll offer a personal anecdote of why this is happening. If you think of like my mom as a consumer, if she is thirsty, when she go to the supermarkets, in her eyes, Coke is the same as Pepsi is beverage, and water is the same, and even beer is the same. So to her, in her mind, whichever liquid offers a cheaper price tag, she will buy it to solve the problem of being thirsty. And essentially, Coke is not just a duopoly with Pepsi. Now it become the same as water, the same as beer, so it's competing with a much bigger market. That's why mass market consumer products in the past has been extremely price sensitive and competitive because the consumer has a very different mindset and brand just simply doesn't stand out. And I think the new generation was completely different because A new generation, when they step into the store, they know, am I a Coke person or am I a Pepsi person? So they will go directly to the products they have an idea for and don't waste the time compare prices with a beer and then just go out of the store. So that's an anecdotal story, but that tells a lot about how this new generational shift would materially changing the margin profile, the pricing, the strategy of the companies. And then I'll quickly discuss the next stock example, which is a new local business, what we call software. We all know that China consumer internet companies in China are the largest globally, even despite they most focusing on China alone. In contrast, the business-related software is still in a very early stage of development. These includes office software, ERP, which is enterprise resource platform, cloud. All of these segments each command about $500 billion value globally, while in China they're tiny. Why? I think there are two reasons. The first is previously this is a global market, right? So a very limited room for local players. So Microsoft is dominating globally. Secondly, there's a generational shift which lags in the corporate world. In the consumer internet, the cool kids would get the iPhone and actually teach his grandma how to use it, how to use WeChat, how to use WhatsApp in the US case. And the penetration is pushed upwards. However, in a more conservative corporate world, IT decisions are decided at the boardroom level. And the previous Chinese corporate managers doesn't even use PC properly. But the new generation managers coming online, but also cloudification allows everyone to skip PC, now go directly into mobile and cloud. So Kingsoft is the largest software company, office software company provider in China. It also owns the third largest cloud service. So it has office, cloud, and also with many other assets, including gaming. So it sounds very similar to the business mix of Microsoft, isn't it? The only difference, this company is trading merely at less than 1% of the value of Microsoft. If we look at the valuation matrix on the right-hand side, it basically contrasts Microsoft with Kingsoft, and you can see that each segment that there is a significant potential to increase the value. Now the question becomes, well, is this because this company is relatively unknown and there's a very uncertain path for it to extend to compete with Microsoft? Actually, no, because it has more than 90% market share in China back in 20 years ago, before Microsoft entered the market, become a global market. But now, entering into mobile era, and as the market gradually localized, it has now 500 million monthly active users versus Microsoft's 300 million. I mean, certainly we're not comparing apple to apple, given a lot of Kingsoft's user are using the free version, where Microsoft's user doesn't have the free version. But still, you have a 500 million user, which is even bigger than Microsoft's consumer footprints. The paying ratio is much lower now compared to Microsoft at only about 3 to 4%. Nonetheless, the long-term track is very clear, because this company have 100% market share in state-owned enterprise and governments, and also it's going to gradually have, in a cloud era where national security and information storage become very important, it will gradually, we aim to reach about 80% market share in China. And the paying ratio, we aim it to reach about 30%, which is lower than Microsoft still, and ASP to only $30 a year, which is not a stretch. That would boost the company franchise in Office alone to $120 billion, right? Still a bit shortfall from Microsoft, but that's a significant increase from today. And the small anecdotal things I would like to highlight is it does lost a significant market share to Microsoft during the PC era. And however, we see their products is much more mobile and cloud friendly. User not only need, if you use Microsoft, you have to install about 1 gigabytes on your iPad or your PC. But in here, user only needs to install one small package rather than 4 to 5 big ones. And the package size is much more suitable for mobile usage. Meanwhile, it supports PDF editing and facilitates sharing on social media, provides millions of templates for easy editing. So basically, it's born, sort of reborn in the cloud era, on top of the localization trend we mentioned earlier. So adding up all these investees' value, which on the lower right-hand side, we believe the value in the longer term could reach about $100 billion for this company, and at least about 13 times upside from today. So I'll skip this one, and now we're at page 15. This is a good place to recap. So essentially what we try to do here is to apply our Lansdowne DNA and investment process in China. And at the very core, we are a fundamental-based equity strategy combining global insights with local presence. Our investment process started with the entire Chinese stock universe, which is about 5,000. And then we, through research filtering and through our investment framework filtering, we arrive at about 500 stocks. And after meetings, we arrive at about 100 core stock universe. In the end, we aim to construct about 15 names, which is a highly concentrated portfolio, focusing only on the underappreciated opportunity, essentially the body of the panda rather than the head, which is has both attractive upside and high certainties. The long book, after the fees, has generated about 20% CAGR since inception versus about 15% versus the broader market. So now, thanks again for your attention, and really appreciate the time, and I'm happy to take any questions.
Thank you, Yang, for your presentation. Very interesting and clear. Now we have time for questions. You can send the question through the chat or through the system in Zoom, or if you prefer, you can raise your hand and to do the question directly to Hank. Hank, I received during your presentation one question. I'm going to start with probably the most relevant question for us. You know that Chile is a large copper producer. So the question is, do you see a new commodity super cycle handled by the China demand in electric cars, clean energy, technology?
Thanks, Camila, and thanks for the question. I think the answer is yes for selected commodities if we take a much longer time horizon. Selected segments of commodities such as lithium, cobalt, copper, or nickel, these are paramount ingredients for batteries or even for hydrogen production into the future. Because I think eventually electric battery and hydrogen could be both complementary for achieving neutrality of emission. And these elements will experience solid demand support, and essentially could become the new iron ores for China, but also for global demands in renewables. However, I think the recent short-term price volatility is much more driven by US monetary policies, much more relevant driver, and also some of the supply chain bottleneck. Because, logically, if China and the world is decisively shifting towards clean energy and advanced manufacturing, coal, steel, and oil price shouldn't move up, a lot. Actually, it should move down rather than higher. After all, essentially the goal to be clean and renewable is to consume less. So that's why my conclusion is, again, similar to our investment strategy, being selective. For the selected parts of the commodity, there is a very bright future, but overall, as we turn greener and more, sustainable development in China and the world, consumption on the bulky side of the equation, such as coal or cement or these things might actually decline.
Perfect. Thank you very much.
Thank you, Jan. I have other questions, mainly regarding the risk. um, how do you see the risk of the high level of the corporate debt? Do you see some problem for the growth of China in coming years? Because it's a very recurring concern in the investment community.
Yes. Thank you, Arturo. On a broad macro level, the high level of leverage in China, especially in China, is more the corporate leverage. In the US or other developed markets, more consumer and government leverage, will eventually reach a kind of unsustainable level and slow down growth, either in China or globally. That's somewhat already true because the Chinese government's already slowed down its previous 7% growth, sort of magic number 7%, now to move to a more band between 4 to 6% in the next decade, in order to allow the economy to breathe, to properly adjust and deliver. This is also the exact key points of our webinar today. One might not be surprised now that most of these corporate debts are in the head of our panda picture. So for the underdeveloped area, this might actually be good news because there will be less competition for both talent and resources. Again, I'll give a very numerical example. If we take the property versus diabetes again, which is a very good example to put numbers around. People in China were spending $3 trillion a year, not one-off, a year annually on property investment, right? There's a lot, these are big savings part, while only spending $6 billion on diabetes drugs such as insulin, etc. This is despite that China has 1/3 of the global diabetic patients, right? 1/3 of the patients. So if the $3 trillion growth rate is slowed down from 10% to 0, so instead of growing, it was basically flat, assuming that, then people would have $300 billion more on something else, right? Such as saving one's life by taking insulin shots. So essentially, this is, if we just attach the numbers, of course, this is like 50 times growth from the base of 6 billion. So when we put the equation together, yes, the high level corporate debt, specifically in China, is already causing a relatively slowing down of the growth potential in the overdeveloped area. However, we do believe that the readjustment and rebalancing would allow the underdeveloped area to rapidly develop no matter whether the macro situation is. So it's more a macro independent growth.
Okay, thank you, Jan.
Thank you, Yang. I just received another question for you. And we know that in 2020, China A-share market was probably one of the best performing markets. Do you think this rally could continue?
Thanks, Quinn. Thanks a lot for the question. I think it's not speaking on our own book, but I think the answer is yes. And the simple answer is yes, because it might not still be the #1 in the world, but it will be doing decent. The logic is relatively simple. From our ego and panda charts, right? Which this is only a single chart I wanted you to remember. The ego and panda charts, which is obvious that the current China market equity market is significantly underrepresented in global investors' portfolio, and also very small relative to GDP. So in the long run, it's going to be a good market to be in. Now, the caveat, the small caveat we have to pay attention is certain part of the market is already quite expensive and sizable, and not at all exciting from our perspective, which we highlighted, such as spirits or life insurance we discussed earlier. This is like the panda hat, which is kind of okay, will still grow with overall maybe slightly slower than GDP, but not necessarily exciting. But it happens to be where a typical global investor or index would put the money in. Therefore, we think, yes, China would be a good market to join, the growth with, but the right way to participate, given its uniqueness, is really through a differentiating stock selection rather than buying the most obvious ones. Thanks.
Thanks, Yang.
Yang, thank you very much for your presentation. We don't have more questions and we are on time, so perfect. Thank you to all the people that was connected. We are going to send you the presentation, and if you need anything, you have questions, please contact us. Jenny, thank you very much for the coordination of everything. So,
Thank you. Goodbye, everyone.
Thank you. Goodbye, everyone.
Thank you.
Really appreciate the time.
Bye.
Thank you, Arturo, Juan, Camila. Thank you.
Bye.
Bye-bye. Bye-bye. Have a good night. Have a good day.
good night. Bye-bye.